Well, there has been waves of debt crises since the 1950s or 60s. But today is different because, in fact, developing countries are faced with new challenges, having accumulated a large amount of debt over the last 10 years. Why? Because they took advantage of cheap liquidity, investors who are willing to buy their bonds at very low rates of interest, very low yield. And today they are in fact challenged by a number of converging threats. Number one, lower liquidity, risk aversion by investors. Number two, higher rates of interest. And number three, lower export revenues. In fact, they face an environment of shrinking growth, shrinking export, shrinking trade, and also shrinking foreign direct investment. So we have in front of us, a number of countries which are likely to be affected by severe liquidity problems and maybe solvency problems. The difference between liquidity and solvency, that liquidity can be rolled over, can be refinanced, you can stretch the maturities, giving money and time to these countries to pay back. The solvency, let's take, for example, Tunisia, which has a debt to GDP ratio of 100%, This country cannot keep servicing its debt, or it will be at the expense of its population. So we are close, in fact, to serious debt problems in the case of Tunisia. Now, on top of all these threats, we have the geopolitical tension with the Russian invasion of Ukraine. And the spillover is not only on Eastern Europe and Western Europe, but also on the 1.4 billion people in Africa. Africa is very remote to the battlefield, but still directly impacted by the war. And why? Because, in fact, trade is disrupted, growth in the world economy is also shrinking, and you have countries which face this new crisis with a very large debt burden. Practically speaking, Nigeria has a debt servicing ratio, which is, in clear terms, is a ratio of revenues which are eaten up by debt servicing of 85%. 85 cents out of $1 of revenues is used by Nigeria to pay back its debt. Kenya 60%, Zambia 50%. So all these countries, are struggling with a number of threats, of challenges. They need, in fact, to increase the revenues in order to confront the pandemic crisis, in order to confront the poverty challenges, and they can't, because they have to pay back today the accumulated maturities of the last 10 years. That will be done probably with three mechanisms, a sort of financial architecture set up by the IMF, by the World Bank, by the Paris Club, and by the OECD. So we have three instruments. And that won't work. It won't work because, number one, the structure of the debt has changed over the last, I would say, 10, 15 years. And why? Because, number one, gone are the days where banks lend money to developing countries. There have been a number of debt crises which in fact have led to a risk aversion of banks. Today you have capital markets, bonds, and in case of debt restructuring, you cannot call the bondholders in one room, so it's much more complex. And number two, you have China. In fact, there's a share of Chinese loans in the total public official debt of these countries. It gets larger and larger, very large for Tanzania, for Kenya, for example, for Zambia also. And China is not at all willing to sit at the table and to renegotiate the debt. Not only it won't renegotiate it, but more seriously, it might in fact seize the assets, collateral, the guarantee, which backed up the loans, the Chinese loans. So these countries might have in fact to provide China with mining assets, maybe with infrastructure assets, like in Greece with the harbor of Piraeus, or Sri Lanka also with a harbor. So we are going to have months or years of tough, complex, protracted negotiations, and several countries will have to default, basically.